techniques that keep people poor. Um, why talk about something like this? It is no secret that Australians are among the highest taxed people in the world. We're victims of the tax system, and we're everywhere, in particular those with increasing income. Why? Your income gets taxed outrageously. It does not make sense. But the government is ruthless towards the same people dedicated to supporting its economy, and that's us, the unsung heroes of any successful country, hardworking people. You, most of the time, me as well. The truth is simply that without hardworking and earning people, much of the government would not have any money for their overspending and wasteful projects many times. And let's face it, even if you're only making $110,000, you're already paying over $17,000 in taxes. What would you do if I gave you $17,000 in cash right now? Actual dollars in your property investment, well-deserved holidays, a better house with a nicer car, but make a little bit more than that and watch the ATO rip out 45% of your income. Yes, that's a lot of money to just give away, up to the point where the government takes more than half of what you make. They'll always want their pound of flesh. And the system that is supposed to increase your wealth, it merely shrugs its shoulders as your financials are bleeding on the cold ground. No wonder it feels like there is never enough money, no matter how hard you try to save. Especially when you have worked so hard, put up with the longest hours ever, the ever-increasing admin burden too. Still, some of you are paying up to 45% in taxes. I mean, what the hell? Something is horribly wrong with this picture, don't you think? If you could keep that money and invest it wisely, you could be a millionaire in just a few years, thanks to compounding. Well, why not? If you work in Australia, you kinda have to. And if you're on a relatively decent income, you are already giving away all that money to the ATO. That is, you are already generating enough cash to do way better than you are at the moment. And you're likely not scared of a little number crunching, right? Besides, you would have to go through thousands and thousands of pages online on the ATO's website to get what I'm about to cover very quickly in just a few minutes. So this actually saves you a ton of time too. So let's get started. Let's claw that money back from the gov. I'm sure you can make better use of it than they do. First hack I'm going to talk about is how to combine multiple tactics to come up with your own recipe. So everyone runs off to invest in property as soon as you start talking about taxes, negative gearing and so on. Property values double in Australia, if you believe the news, all the time. Well, it's kind of true. There is actually a lot of money to be made in property. Some simply buy and hold, others use negative gearing. There are probably another 19 other similar tactics. So should you just jump in and go nuts like everyone else? Maybe not. Actually, the real money is to be made by combining a few of these property tactics together in the right amount too. The last person we saw implement the following tactic ended up in a multi-million-dollar mansion from living in below average conditions too. It depends usually on two variables. There may be more, but your personal financial circumstances will play a big role in your personal preferences. As a little sidebar, speaking of personal preferences, here's a little hack. Many people hate this, but it makes millionaires. Like with all things property, depending on when you're reading this, check interest rates and all that. Step one, you rent. Don't buy your primary residence. That is cheaper, and if you're running a business, you get more deductions by doing that. Step two, buy a rental with the freed up cash and tax benefits that you've gotten from step one. Now, this tactic combines all sorts of tax offsets and deductions plus a better cash flow too. The result, you build wealth, mostly at the government's expense. Your investment property becomes so affordable it's a joke. Because of that, every few years you can add multiple ones. Because as you know, your property goes up in value, building a multi-million-dollar property portfolio in a few years flat. Why? It's basically a secret combo of powerful tactics. Here's the list of ingredients. Good detailed tax advice. Not that crap where the accountant just takes your details and fills out a form, instead of actually going through all the expenses one by one and examining investment strategies that actually fit your lifestyle and financials. Plus, good property advice. Work with an experienced property advisor to save time or call us. We have a great one in our tax practice. Plus, benefit from the current macroeconomic regime, a government that has a housing crisis to solve, therefore very willing to help property investors out, for now anyway. Plus, establish an SMSF, self-managed super fund, so your super can be used towards a deposit to purchase an investment property. Added bonus, your super becomes diversified, less chance of losing the lot in the stock market. Talk to your financial planner first about that one. Plus, you get a deduction when you contribute extra. Don't forget to ask your super fund for the right letter and make all the additional admin stuff before you make the contribution, otherwise you may not get that deduction. More, any gains or profit that you make throughout the super fund can only be taxed at 15%. Compare that to up to 45% on capital gains. With super, you tend to win on the way in and on the way out too, which makes us a favorite of the wealthy too. See the difference between getting your return done yourself, or a quickie at H&R Block, or working with a proper senior accountant? There's a big difference. Okay, hack number 2. It's more like a reverse tactic. Not doing this will make you rich. Well, potentially, with a lot less risk. I put this on Facebook and LinkedIn and it kind of went viral. Many accountants and advisors agreed with this as well. So, if few astute people eliminate their risk by a little education. So you can attend a few property events, or reading once or twice a month on anything tax related in the news. Usually takes less than 5 minutes. But there are 3 counterintuitive things you need to understand before you do your taxes. Have a basic understanding of taxes. Don't give up all your control over your own financial destiny. An accountant is just a supplier in the end, who bears no risks sometimes if you're not getting the right advice. Also, have a basic understanding of tax minimization strategies. For example, using property or super. Most accountants won't cover that with you and will happily just file a return without fully exploring all avenues. Have a basic understanding of the ATO2 and how flexible and where they can be flexible. Without that sort of basic understanding, most give their issues to experts and trust them to do the right thing. Most times that's okay, except for when it's not. Tony Robbins once lost $700,000 doing just that. He gave up that control, and that's what happened. I hope people reading this take action now. Again, as an inspired engineer of growth, leverage your ability to deal with complexity. You are better able to skim through these financial articles with great ease than most, and that will save you a lot of costly mistakes down the road. Okay, hack number 3. Maybe it's not property at all. Many people in Australia start their investment journey with property. That is usually a huge mistake. They do so because they can see property values increasing all the time. It is tangible in their minds. After all, you can physically touch a house. It's right there, as opposed to $1 million in 10 years, which is just an amount. That's on a piece of paper somewhere. And you can't usually directly witness that sort of increase in any other forms of investment, whereas in property you can. You can almost guesstimate the increase. Just go on realestate.com.au and look at neighboring properties or something. However, and it's a big however, selling a property investment cops soul-sucking, soul-crushing capital gains tax. Not to mention, you'll pay up to 45% because of your tax bracket on anything you ever make past a certain point. Secondly, most don't factor in inflation either. We have, and you get hit again. Turns out property only gives you a 5.3% rate of return after you have paid all the required tax and accounted for your expenses and investment, and slightly less than that once inflation adjusted. Most people always think there is more than that sort of return from property, that the return will be more than that. Nah, wrong. Most don't get better returns than that. Some will get lucky, but hey, you might as well go to Crown and risk your money, right? Now, if this is going well on property, even if it doubles in value, we're talking about 5.3% on a good day. But there is another investment that gives more return than property. And I need to tell you this, I'm not a financial advisor and usually don't do much with them. I'm an accountant. By the time you read this screen or listen to half of my advice that I've said here, things may have changed already. So I can only tell you what I have seen others do, and I can't tell you if any of this will work for you individually unless I've had a close look at your financials. So basically what I'm trying to say is don't attempt anything from this video on your own without a proper sit down with an accountant or at least a financial planner. Okay, Now, did you know that even super funds, if you structure them intelligently, can give you a return of 8.3% on average? Because the government is not very keen on taxing retirees. However, the government doesn't mind taxing shares on property profits or property profits. So max up your super. Just contribute as much as you can over there. In fact, we used to be able to put a lot more. Now there's a cap of about $2,000 a month in most instances. Still, that's 60% more than you get from investing in your that you'll get from investing in your super than you would ever get from property. Your super would grow, and investing $1 million in super, you would make $170,000 cash, more than property. So what would you do if I put $170,000 in your bank account now? I think you get my point. I know super is not sexy, and most people say, well, what would you do if you went for a GFC American style? Well, then property comes a hit too. These are just national things that no one can hide from. Okay, one assumption here, just quickly, we're assuming that you have already about $200,000 or more in your super and can get a gain of 8.3% over 20 years. It could be more, it could be less. It is rarely less, but please, again, contact your financial planner before you start making any of these decisions. I can't give you advice on SMSF. All right, next hack, where you will most likely fail. If you have listened to me this far, let's take a hard and honest look at your situation. Perhaps you work full time. Now and then you have to stay back at the office. Maybe every end of month you have to work extra, trying to get a promotion. You work even more hours. Then you have to take care of your house chores. Maybe you're in a relationship, which again takes time. You have to spend time with your wife, girlfriend, boyfriend, otherwise run off for half of what you have invested anyway. If you have kids, oh boy, they take even more of your time. Although that is a good thing. That's the fun part, right? But still, it takes time. In fact, most people are lucky to squeeze in some Netflix and get 6 hours of bad sleep or less. And then the weekends just fly by as you wave the fleeting Saturdays and Sundays of your life goodbye. You only get a few weeks off every year where you desperately try to recharge your batteries before you come back even more tired. Then you need a holiday to recover from your holiday. I know how that feels. Been there, done that. And that's right. Now I'm asking you to do even more. And the bottleneck quickly becomes, you've guessed it, you. You are the bottleneck. To be more precise, your time is. In fact, having taught or implemented very good financials for thousands of people over the last decade, I can guarantee you one thing. Maybe 10% of the people reading this or listening to me talk right now will take any action at all. Out of those few, 20% will actually completely implement anything at all. So we're saying 2 out of every 100 people that are listening to me right now will actually see this through. And that's only the people listening to this. Yeah, it's a bit depressing. A measly 2 out of 100 that will listen to this that will actually take any action towards realizing wealth that only multimillionaires may have access to. Why? One thing, not enough time. Modern society simply won't be denied. But it will happily deny you your chances of making millions, though through better investments, your chance of leaving a real legacy of wealth and giving your loved ones the lives they truly deserve and want. Unless, there you go, unless you learn some really ninja financial discipline. So here's a basic course on just that. In fact, allow me to show you 3 different ways busy folks like you are doing it. My last hack, the easiest one, is get a financial coach. Well, it kind of is a hack. Think about it. Or a good accountant that focuses on helping just people just like you. And, you know, this person, like myself, will ensure you never waste time or money on ineffective money tactics. So you don't have to look around to find the right ones. They'll tell you which ones are the right ones, saving you a lot of time and risk. Understand the more complex stuff and they'll simplify it for you. So complexity does not stand in your way. You don't have to spend hours and hours trying to figure things out. And they'll hold you accountable every month. So you stay on track. You never fall off, which is important, right? Probably do some of the heavy lifting for you too. Whenever you get stuck with anything that's taking too much time, taking too much money, you're trying to find a way to do it for less, you've got to find access to a financial expert. So you'll reach extraordinary financial results that most people can only dream of. And you'll do it quick too. Yep, we are potentially talking about mansions maybe for some of you, holidays for others, or fancy cars, whatever you're into, a different life even. Who knows? Money changes things. For many of you listening to this, You may be able to get things that are beyond your reach at the moment on your current financial trajectory. Don't want to overpromise there, but good financial advice, when put into play in the right situations, can take people to places that they never dreamt they could reach. Unbelievable, I know, but you will never know what you're missing out on unless you reach out to a good financial coach or an appropriate accountant and find out for yourself. Of course, this will vary from people to people, and there are other economic variables that come into play as well. If you're trying to do this in a recession or something, it may not work as one variable, and there are many other variables as well, which is why you need to talk to an expert first to see whether that is within your reach. Now, if you want to try this, some ways to tackle this, here's one. Okay, this is called the salami approach, but we're not talking about pork here. It's a tactic to perform tasks by leveraging human behavior. Humans develop habits, bad and good. If you do anything over a few weeks at the same time every day, it becomes easier and easier. It actually becomes hard not to do it if you reward the activity, even a little. So good financial management is basically a list of activities to do, which to many feels like a mountain, too overwhelming to even get started. Unless, unless you slice those tasks into thin slices, like a salami, hence the name. So for example, you can decide to look at your financials at 9 o'clock every day for 10 minutes, something really easy to accomplish, right? Takes about 10 minutes out of any schedule, but after a few weeks you'll find it is easy to stick to this routine, and you will actually never forget to keep increasing your know-how and wealth. Brian Tracy actually first mentioned this, the salami approach, and in just a matter of months, just think about it, you would have clocked hours and hours focusing on improving your financials. You, a highly capable person with a well-trained brain for complexity. If you're human and you live these days, yeah, you can handle complexity. Look at the world we live in. You have to be, right? Armed with the right advice too, you're unbeatable. Financially, a rock star. You've clocked over 60 plus hours on your financials and you never even felt it. That's the best part. Can you imagine how far ahead you would be compared to people that don't do anything? How much extra money you could be making investing instead of just giving it all away to the ATO or investing it in things that don't work out too well. Anyway, that's not the last hack. I was kidding. Way more goodies and free tax monies for you. Just keep on listening. Oh, before I keep on going, there's a bit disclaimer here. You need to read this. It's basically saying that you need to talk to a proper accountant um, before you make any decisions. Don't just watch this video and then go for it. Okay, while you're reading that, don't mind if I just jump into hack number 6. So putting more into super thanks to rollover caps. This is from the ATO. They allow you to carry forward unused concessional contributions. So basically you're allowed, let's say you're allowed to put $25,000 in to your super, and this year you only contributed 12. Next year you will be able to put your $25,000 again, and the 13 that you didn't contribute this year, you could also contribute that in there. So 2 or 3 years, 3 years is about $75,000 that you can contribute to your super. Why is that important? Remember what I said before. Money you put into your super, you get as a deduction, and eventually you get to use that on property investments. That's crazy if you think about it. So you're basically just getting a deduction for moving your money from one spot into another. That's how that works, which is really cool. I call it like the last tax loophole still left in Australia. So um, it's one thing I've mentioned is this is a very technical part of the financials, if you want to call it that. So make sure you talk to a financial planner when you're doing this stuff, and even your accountant or myself, we're not really authorized to give you advice on this. We can just tell you what other people are doing, but we can't tell you whether this is the right thing for you. You need to find someone that can do that for you. Okay, I'll end here. There are a few other hacks that I have that could probably help you. I'll leave a link down the bottom where you can find some of those. The rest down there. The next hack that I've wanted to cover, but I think it's getting a bit long, is on crypto and other sort of investments that people are making with some of the cash that they have. And also there's a list to a checklist for you to go through um, and look at whether you missed out on any deductions potentially in your tax return when you're doing it. It's a useful document, and more importantly, it's free. So there you go. And don't forget, if you need any help from an accountant, and you want someone to look at some of your financials and give you the right advice, give us a call on 1-800-672-670. I'm Darren Virapa, and I would be happy to help you personally.